Welcome back. And in this video, we are going to do an Excel exercise dealing with real options. So the idea is that we're going to compare how a decision to get into a project or reject the project, accept or reject the project, can change depending on the options you have available to you. So let's start with information that we have. So there's an investment outlay of $500,000. The project can last up to 6 years. There's an after-tax cash flow on the low end that would be about $80,000 a year. The probability of that cash flow happening is 50%. There's an after-tax cash flow probability on the high end of 140,000 a year, with a probability of 50% of it happening as well. So what we have here is that if you go the entire 6 years, there is no salvage value of the equipment. However, if you do exit the project or abandon the project after 1 year, you could recover 400,000 in salvage after tax. And we will assume or say that the required return for this project is 12%. So let's set up the NPV scenarios. So on year 0, the cash outlay would be $500,000. If we go with the low end first, it'll be 80,000 every year. We're going to keep it simple. We're not going to do uneven cash flows. We're going to assume the same cash flow year after year. But this can also be done with uneven cash flows. So to get the NPV, we want the present value of these cash flows. Now, since these are even cash flows, we can easily use the present value formula in Excel. So we get the rate, which is the 12% required return. Periods is going to be 6 periods. The payment, we know, is 80,000. They're the same, so you can pick any one of those. And we don't have a future value, and the type of B, we can leave it at blank as it is. We can stop there. And allow me 1 second, because that is the present value, so we have to put that positive. Okay, so that's the present value of these cash flows. All right. Now for the net present value, we add these two together, and the project with the low cash flows gives a negative NPV, which talks about or starts indicating that you might be rejecting this project. However, remember that it's only a 50% chance of that happening. So let's run the numbers with the high cash flow. So we got the $500,000 outlay, the 140,000 that will come if you get the high cash flows after tax for 6 years. The present value, let's go ahead and copy and paste, but we got to make an adjustment here for the rate. Everything else can stay the same. That is the present value of those cash flows. And if we go ahead and add those two together, we get 75,597, a positive NPV. So we have one scenario, the 50% chance that will give us a positive NPV, and another scenario with a 50% chance, again, is a negative NPV. So we can do a weighted average NPV, which is going to be the 50% probability of the low one happening, which will be this one, plus a 50% probability of the high cash flow happening times that NPV. So we still have a negative weighted average NPV. If we were to stop here, the idea will be to reject the project because overall the average still gives the negative NPV. Now, if the percentage were to change, let's say the probability of the low one was to drop to like 35%, still negative, maybe 30%, now it's positive. So if the probabilities were to change, then the outcome may change. So you have that option to manipulate the probability by hedging, lowering risk in other forms, then sure, you can work on that, but there's the reality. Or maybe you can work with the required return, make the required return a little lower. If you're able to work with a required return, you see how your weighted average NPV changes. At 8%, we definitely got a positive. But let's continue with these numbers the way they are. Now, let's consider that, well, if you didn't have any other choices, that's where you are. You can then try to work with the numbers you have here. But we do have this other choice of having a salvage value in year one of 400,000 if you decide to abandon the project. So let's see what it looks like if we only do it for 1 year and abandon. So let's start with the low cash flow. So we know that the initial cash outlay is still the same. We're doing the low cash outflow, but now we have a salvage value to include here. That if you get out, you can still get that cash back after taxes. So what happens is that cash flow after year one becomes 480,000. So we want the present value. Now in this case, because we only have one cash flow, we can just easily pick the cash flow, the 480, and divide it by 1 plus the required return or the discount rate. And that is the present value of that cash flow. Once again, add these two, and we still have a negative net present value. However, notice the difference. It's almost $100,000 better. So while the NPV is still negative, it improved a lot. Okay, so let's go ahead and repeat the process here, but with a high cash flow. We get the $140,000 there. Now salvage value will be the same. And we can practically copy all this and just fix the interest rate one, not the interest rate, but the required return or the discount rate. And that's the situation. So now, if the high cash flow situation was to come in play, you end up with a negative NPV if you choose to abandon the project on year one. However, this is what we call the option. Since you can choose to stay in the project or get out of the project, you have a choice, you can stay in. Now it opens the door to that you can start the project. And if you get the high cash flows, then stick with it all the way through and you end up with a positive NPV. You don't want to get out because I'll give you negative NPV in the high cash flow. But if you on the first year you hit the low cash flow, you can choose to get out and lower your losses, minimize your losses. So once you start having this option saying that you can choose here, which is the better one between these two, or choose here, which is the better one between this one and this one. So let's see what the weighted average NPV looks like now, because we're going to choose, because we do have the option to choose after the first year to continue or drop. So if I get the low cash flow, I would choose to drop it to minimize my losses. So that means I'm going to take this NPV and multiply by the 50% chance of that happening, plus this NPV, because if I get the high cash flow, I will choose to continue, times the 50% of that happening. So now we have a positive NPV average. So you will select to move forward the project. Do you still have a chance of this going negative? Yes, it can still happen, but your losses have been minimized considering the scenario. And this is how having a real option after you start the project, in this example, to exit and recover money can then give you an improved average NPV, and you may choose to then do the project because now you have a good chance of still making some money. And of course, you could have a cash flow anywhere in between. It could be 80, it could be 90, it could be 140. All right. So, and if you want to know what kind of tolerance you can have on this, an example is to say, well, it's a positive NPV, but how low can my cash flow go before I say, no, I won't do this? This is where you can use Solver, for example. So we want to know what happens. How low can this number go? Well, this becomes zero, because and that becomes the indifference point. Because anything below zero will be a negative NPV and reject the project. So no problem. We go to data, we go to Solver, and we're trying to, well, the objective we're going to set is this one, F20. We want to select a value of 0. We want an exact, we want to say, please make this a 0. So I know that at that point, anything below there I reject, anything above that I can accept. And the value we're going to choose to change, let's start with the low cash flow. Let's see how low can we tolerate before we have to say no to the project given these scenarios. So we hit solve, and we did get the 0. So your low end cash flows can go as low as 75,331 for that to hit 0. Anything below that, you'll have to reject the project. Anything above that, you may continue with the plan you had. Now, you may still, with the plan you had, may include this option still. But what we're saying is that when you're in the calculations, if some new numbers come in, you would, that's where you know that that's as low it can go when you fine tune your numbers. Now, another one you can do is, you can also do this with how low can your high cash flow go. So let's just do Solver again, but now we're going to change that to this one here. So it cannot go down too much, only like $1,000, and you already find yourself in a situation that you might not want to do the project. Now, so let me just lower the volume here on this. So what about the probability? How much can the probability of the low cash flow go up before you choose not to take the project based on the weighted average NPV? So we go to Solver, we still want that to equal 0, but now we're going to change the probability of the low cash flow. So when you do that, what it's telling you is that you can't go up too much in probability. An increase of about 1.42% will put you at weighted average NPV 0. Anything above that, you shouldn't be doing the project. That's if your probability of the low cash flow goes up and this one goes down. Now, of course, and the way that worked, by the way, we had this set up for 1 minus that 50%. So it always adds up to 1 of those two. If not, Solver won't be able to do that for you. Keep that in mind. And well, but of course, that if the probability was to go the other way around, as this one goes up, your NPV will just go up. So that's it for this video. That's an example of a real option. And we will stop here and see you on the next one.